In this video, we're going to talk about the Roth IRA tax hack during a recession. So we're going to make lemonade out of lemons. But before we do, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner, helping you reach your financial goals. You're probably watching this video because you have a Roth IRA or maybe you're considering one. Now, if you don't already know, the Roth IRA goes in after tax. So we've already paid our taxes on that account and the money is going to grow tax deferred and tax free. Means that when we pull up all that growth or potential growth comes out tax free. So the real benefit in the Roth IRA is no tax on the growth portion. And when you're looking at the Roth IRA, you're thinking, well, it's a pretty good retirement plan because I'm going to put the money in for 10, 20, 30, 40, 50 plus years, and all that growth won't be taxable when we pull it out in retirement. And not only that, you don't have RMDs or required minimum distributions like the other retirement accounts do later on down the road. You can access those contributions whenever you want, and you can use the money for qualified higher education expenses, or if you're paying medical insurance premiums during the periods of unemployment, or for a first-time home purchase up to $10,000 for a lifetime limit. And thanks to the Secure Act of 2019, which was signed into law on December 20th of 2019, you can also use up to $5,000 for a birth or adoption. And it is a pretty good retirement account. And on the other side, we have the traditional IRA, which is the same as a traditional 401k or a 403b or a 457 that goes in pre-tax. So you're not getting any tax taken out of those dollars, grows tax deferred, and then comes out taxable later on down the road. So all the money that you put into those accounts is then taxable as ordinary income when you pull it out. And when you're comparing these two different types of accounts, you're saying the Roth IRA makes a lot more sense because I have a lot of working years left and I'm just going to leave it in there forever and it's going to grow to infinity and everything is going to be great. And then this happens. A virus breaks out, becomes a worldwide crisis, a pandemic, and not only does the market go down, but incomes are going down and jobs are lost and maybe yours too. And you might be thinking, what else can I do? So you're watching this video, you want to hack, you want to save on taxes, and you want to know what you can do with your Roth IRA to get it working even harder. So here's a strategy that you can use with the Roth IRA right now. And if you don't have a Roth IRA or considering using a Roth IRA, this strategy will still work. So here's how it works. Any of the contributions that you put into the Roth IRA, as I mentioned previously, you can pull those dollars out. So if you can pull those dollars out, that means you can also put them into the traditional IRA. And you might be thinking, wait a second, I put in the maximum amount into the Roth IRA. And I thought I can only put in the maximum amount into traditional and Roth IRAs together. And you are right. But if you haven't filed your taxes just yet, you can take the contributions that you put into the Roth IRA for 2019 up until the tax filing deadline. You can pull those dollars out and put them into the traditional IRA instead. And the benefit that you're going to get right there is you're going to save on taxes immediately. And you can see this in publication 590A. Now, this is a document from the IRS's website that outlines how you can make this change. So here you can see recharacterizations. You may be able to treat a contribution made to one type of IRA, in this case, a Roth IRA, as having been made to a different type of IRA, a traditional IRA. This is called recharacterizing the contribution. Or you could take the money out and you can see the contributions returned before the due date of the return. And that's the important part. There's a timing that you have to pay attention to here. So if you made the IRA contribution in 2019, you can withdraw them tax-free by the due date of your return. And why would you consider something like this? Because right now the market's down. Not only the market's down, but your income is probably down too. And if your income is down, that means there's a good chance that you've made more money in 2019 than you will in 2020. And if that's the case, you could pull the money out of the Roth IRA, put it into the traditional IRA for 2019 and reduce your tax liability in what you thought was a lower income year, but now it probably is a higher income year. So because it's a higher income year, put it into the traditional IRA, it will reduce your taxable income. And even if you're thinking, I still want to keep the Roth IRA because we talked about long-term investing before. Well, You can put it into the traditional IRA, do a Roth conversion on those traditional IRA dollars into the Roth IRA, and you're back where you started, but the only difference is now you have a reduced tax liability for 2019. And if you're in a lower tax bracket in 2020, then you'll pay a lower tax rate on those converted dollars because you're doing it in 2020. And let's look at some of this math. If you're in the 22% tax bracket, that means making this change will save you $1,320 in taxes just by going to the traditional IRA and then back to the Roth IRA. And if you're in the 24% tax bracket, that means you'll save $1,440 in taxes. That could come back in a refund or just reduce your overall tax liability for 2019, which is right now. Now, there's a couple of rules that you need to be aware of. If you have a retirement plan at work, like a 401k or a 403b, then making the contributions to a traditional IRA, you have to be below a certain income threshold. If you're single, it's $64,000, and if you're married filing jointly, it's $103,000. Now there is a phase out. So that phase out for singles is $64,000 to $74,000, and for married filing jointly, it's $103,000 to $123,000. And when you make this conversion from the traditional IRA to the Roth IRA, called a Roth conversion, you have to keep the money in the Roth IRA for 5 years. Means you can't immediately take out that contribution because technically it's not a contribution, it's a conversion. And let's go to publication 590B on page 31, which shows the ordering rules for distributions. The reason this is important because I want to point out those converted dollars with the 5-year rule. The first thing that you would pull out of the Roth IRA are your regular contributions. So if you already have regular contributions that you've made or will make in the future, you can still access those dollars. You don't have to wait the 5 years on the entire account. It's only the converted dollars. Now there's another benefit, actually a whole bunch of other benefits about using the traditional IRA versus the Roth IRA. And one of those is the credits that you might qualify for. And that's because the traditional IRA will help you reduce your total taxable income. And if you look at things like the Savers credit, for married filing jointly, it's at $65,000, and for singles, it's at $32,500. So if you can get below those income levels, then you can get additional dollars in the form of tax credits. And tax credits are dollar for dollar. So let me give you an example. Let's say that you're single and you earn $32,500. That would put you at the 10% for the Savers credit. So if you made a contribution of $2,000 into the traditional IRA to get below that threshold, that means you'll get a $200 tax credit. And at the 22% tax bracket, what we said before was you're going to get $1,320 back in taxes. Now tack on an extra $200, that becomes $1,520. And at the 24% tax bracket, that $1,440 now becomes $1,640 in either less of a tax liability or a refund. And if you're married filing jointly and both spouses contribute to the plan, then that means you're going to get twice the credit. And if you want to know more about the Savers credit, I've done videos for both 2019 and 2020 on the Savers credit with the limits and the rules. And the rate can go from 10% all the way up to a 50% credit, depending on your income and your filing status. And there might be other credits that you could qualify for, including the premium tax credit or the child care credit, the child tax credit. The list goes on, but by reducing your income, you might qualify for a credit that you didn't otherwise qualify for. Now, all of this comes from reducing your total tax liability, which is something that you can look at with the traditional IRA that wasn't available with the Roth IRA. Now, the Roth IRA is still a great retirement account, but using the traditional IRA in this scenario might make a little bit more sense for 2019, and you could still convert those dollars for 2020, and you could still make additional contributions to the Roth IRA. So when life hands you lemons, make some lemonade. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.